All right, let's dive in. If you're a lawyer who's taking that huge, exciting step of starting your own practice, this is for you. We're about to unpack the financial toolkit you absolutely need to go from being a fantastic lawyer to a seriously successful business owner. So let's get to it. Look, you've mastered the law. You can argue a case in your sleep. But running the business of a law practice, that's a whole different ballgame. The skills that make you a great lawyer aren't necessarily the same ones that build a profitable, lasting firm. So our goal here is to bridge that gap. To really master this new role, you've got to learn to speak the native language of your business. And that language, the one that tells the true, unvarnished story of your firm's health and performance, is accounting. Now, hang on. Don't let your eyes glaze over. This is not about becoming a math genius, I promise. Think of accounting as a storytelling tool. Every client you bill, every assistant you hire, every desk you buy, accounting translates all of that into a financial narrative. It's how you read the story of what your firm is actually doing. And every good story has a core theme. In accounting, it's the single unbreakable equation. It just means that everything your firm owns, your assets, had to be paid for by one of two sources, either money you borrowed, which are your liabilities, or money you put in yourself, which is your owner's equity. That's it. Everything we talk about next is built on this simple, powerful idea. So let's start with your firm's report card. That's the income statement. This document doesn't just look at one moment in time, it measures your performance over a whole period, a month, a quarter, a year. Did you have a good year? The income statement will tell you straight up. And the formula couldn't be simpler. You take all the money you earned, your revenue, and you subtract all the money you had to spend to earn it, your expenses. And what's left over? That's your profit. Or, your loss. It's the famous bottom line that tells you if you actually made any money. So what does this look like in the real world? Here's a simplified version for a law firm called Shine Justice. You can see it clear as day. Revenue at the top, all their expenses in the middle, and then right there at the very bottom, what's left over? Their profit. But here's where the real insight comes in. We can take that profit number and turn it into a profit margin. For Shine Justice, that's 3.13%. What does that mean? It means for every single dollar of business they brought in, only about 3 cents was left as pure profit. That one little number tells you a ton about their business model and efficiency. Now, if the income statement is a report card over time, our next tool is totally different. Meet the balance sheet. The best way to think about it is like a photograph. It's a snapshot of your firm's financial health on one specific day, capturing exactly what you own and what you owe at a single moment in time. And one of the first things you'll notice on a balance sheet is this split. Everything is sorted into current, meaning it'll be used or paid within 12 months, and non-current for everything longer term. This distinction is absolutely critical because it helps you answer the question, do we have enough cash coming in soon to pay the bills that are due soon? And for law firms, there's a unique and often massive asset you've got to watch, work in progress, or WIP. I mean, look at this. For Shine Justice, it's over 76% of their total assets. That's huge. This is all the work you've done for clients that you haven't billed for yet. It represents future cash, sure, but it is not cash in the bank today. And how you decide to value that WIP is one of the biggest financial judgments and biggest risks you'll ever make. This brings us perfectly to our third and final report, the cash flow statement. This one answers a simple but maybe the most critical question of all. Where did the actual cash come from, and where did it go? Remember, profit is not the same as cash. You can be profitable on paper and still go bankrupt because you have no money to pay your staff. This statement is your reality check. The statement makes it really easy by breaking down cash into 3 buckets. Operating cash is from your day-to-day business, your clients paying you. Investing cash is what you spend on big things like new computers or office furniture. And financing cash is from taking out loans or putting your own money in. Together, they show you the complete journey of every dollar that came in or went out. Okay, so you've got your 3 reports. Now what? Well, the goal isn't just to read them, it's to use them to make smarter decisions. For example, let's say you're thinking about growing your practice. Should you take on some debt to do it? The numbers can help you figure that out. Take a look at this. Using debt, or what the finance pros call leverage, can seriously amplify your returns. Company C, with 90% debt, gives its owners a much bigger return than Company A with no debt. So debt can be a powerful tool, like rocket fuel for growth, but you have to remember, it also dramatically increases your risk. And things can go wrong. Very, very wrong. Because these numbers, these reports, at the end of the day, they depend on judgments and assumptions. So let's look at a real-world cautionary tale that every lawyer should know. This is the story of Slater and Gordon. In 2015, they were a law firm worth over $1 billion. $1 billion. Just 2 years later, their value had collapsed. It was a tiny fraction of what it once was. How does a legal giant just fall apart so fast? The answer was hiding in plain sight, right there in their financial statements. And this is the smoking gun. In 2016, the firm suddenly recorded this massive expense, almost $900 million, for impairment of intangible assets. In plain English, they were forced to admit that assets they had been claiming were worth hundreds of millions were in fact basically worthless. That one accounting judgment wiped out the entire company. Which brings us to maybe the single most important lesson in all of this. Accounting uses precise numbers, so it feels like a hard science, like physics, but it's not. It relies on approximation, on judgment, on interpretation. It's much more like a carefully crafted argument. It's an art. So as you build your practice, remember this. You are the author of your firm's financial story. The numbers don't just happen to you. You shape them with every decision you make. So what story are they going to tell? A story of growth, of stability, of success? The power to write that story is completely in your hands.